Hello, Vedavia community. It is Hammer with this week's mortgage market update. Here to tell you what's going on with mortgage rates and which direction things are headed and what information you guys all should be aware of. This week, I am joined with our guest, Mike Payne. Mike, thanks for joining us, man. Please take a minute and just tell everybody a little bit about yourself and the ice cream truck that you run.
All right, I'm a vetted VVA4 vetted professional in Florida. I love to help veterans get into houses down here. There's a ton of them, and I like to keep it short and sweet.
There you go. Hey, you guys get inundated with a bunch of the rain. I'm on the East Coast too. I'm up in New Jersey traveling. That's why you all have this great background behind me of the hotel ceiling. But we've had. I looked at my little Tempest weather station in North Carolina. I had 3.5 inches of rain yesterday. Did you guys get pummeled in rain?
We got pummeled probably about an inch, and we had tornado warnings and lightning strikes. You know, Tampa area is the lightning capital of the U.S.
Mm-hmm.
So
I did not
lots
know
of
that.
lightning
Is it
strikes.
really?
Yeah.
I know that with the hurricanes, Tampa, when I was there visiting, I think it's called Ybor City, I was made aware, and it could be wrong, but one of the locals said that the way that something is there, that the hurricanes tend to go around it. It doesn't usually get hit with hurricanes there, but I didn't know anything about lightning.
Yeah, there's a lot of lightning. The hurricanes typically miss. But yeah, I think that's why they call the hockey team the Bolts, the Lightning.
Yeah, Tampa Bay Lightning. That makes sense. So, All right, everybody, if you have any questions or comments, please feel free to go ahead and ask. If you're here live, let us know. Doesn't look like there's anybody on live at the moment, but that's okay. We love y'all anyway. Remember, you can watch us on the replay. If you do watch on the replay, do me a favor. Just put a hashtag replay down there. Let us know that you were here, and we will be glad to answer any questions that you have there as well. And I'll fly through some of these slides here. So now let's go ahead and talk about rates. Remember, this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. This is just for you to be aware of what's influencing mortgage rates, which direction they're headed and why, so that you have the information and you're armed with the information to make a good decision. You should always shop around, make sure you're comfortable with who you're working with. Rates have been pretty stable lately, but even still, always a good idea to be checking. So, as far as a quick recap goes, most VA rates have generally been ranging from the high 5s to the mid 6s. If you're not using your veteran benefit to get a mortgage and you're not getting a VA mortgage for some reason, or somebody that you love is getting a conventional loan, or what we call conventional conforming or conventional loan where it's going through Fannie Mae or Freddie Mac, those rates are generally ranging from the mid 6s to the mid 7s. And that's going to depend on credit score. On the lower end, you're generally putting more money down, having a better credit score. With a VA mortgage, little less of a concern about down payment. What would you say, Mike, as far as down payment on a VA mortgage does that affect the rate much, or anything that they have to worry about there?
It can actually, depending on the amount that you're borrowing. If you're getting into jumbo borrowing territory, like above 700,000-800,000, you're going to get a higher interest rate than if you're lower than that. So yeah, it does make a difference. And putting some money down can save you about 0.3% if you're in that high balance area.
Right. So, and if you have any questions about that, again, that's a great question. You can put that in the post. You can ask it in the vetted VA community or of your vetted VA loan officer if you're using one. So the good news, as we've talked about before, the worst rates should be behind us. Mortgage rates have gone up consistently post-pandemic, really started going up at the beginning of 2023. They did move up in 2022, but really started moving higher in 2023. And hopefully the worst is behind us. We did see rates that were touching the 8s in October. It's likely now that we see rates kind of hold steady. They could creep up a little bit from here, but it shouldn't be too much. All eyes this week are on tomorrow's inflation report. And it's a report that comes from the Bureau of Labor Statistics. It's called the CPI report. That stands for Consumer Price Index. We're going to break it down to 4 numbers. There is the year over year number and the month over month. So where inflation is compared to last year this time and compared to last month. Then we have, that's what we call our headline numbers, which is all the variables. And then what we do is we strip out the food and energy costs because they're very volatile. You know, gas prices can move up and down regularly. Food prices can change. And because of that, we have what we call the core number, which removes out those energy and food prices. Core inflation, year over year, month over month. We'll be looking at those. And if we get a reading that shows inflation continues to improve, as we've seen since basically June of last year, then hopefully mortgage rates will have room to improve a little bit on that news. Now, we're not going to see a big move lower, but we could see a little bit of a move on that. So keep that in mind. As far as what's affecting rates, you know, markets believe that the Fed is done raising rates, but if the question is when will they start cutting rates and how much for the year. As we see the markets price in more rate cuts, that helps mortgage rates to actually move lower. If we start to see signs that the economy is slowing or the labor market is softening, rates will probably improve on that kind of news as well, because that helps to keep inflation in check. And inflation is the enemy of our rates, basically. So over the next 15 days, rates are likely to hold steady. I actually needed to update this slide. I didn't get a chance. I should say they could move actually lower tomorrow, depending on what we get for that inflation report. Over the next few weeks, you know, we're not going to see too much. I'll go ahead and pop over here because that doesn't apply. But over the next 2 weeks, you know, we're not going to see too much movement. We have a Fed meeting in 3 weeks at the end of this month. That's when we'll see another opportunity for mortgage rates to take a little bit more of a movement. But overall, if you're out house hunting, you don't have to freak out that things are going to be a lot higher, or you don't need to be pricing that they're going to be a lot lower. But, you know, basically should be very much in that realm of what we've seen now. If you bought a home last year, remember that you are going to have an opportunity to get a lower rate. And I'll let Mike talk about that a little bit. So, Mike, before we jump over to that, though, is there anything that you would want to add as far as where you know, mortgage rates are, what you're seeing in the market?
Yeah, I've seen that they've gone down steadily, and they've actually stabilized. So it's much easier to get, if you got a pre-approval, you're going to be much more likely to have that pre-approval be good for, you know, more than 2 or 3 days.
Yeah, that's a great point. But, you know, based on that rate.
Correct. And then I think they're going to be stable for a while, and coming up to the next Fed meeting, I think they're going to be about the same. And it just depends on when they say they're going to start cutting rates, is when rates will start going back down.
Right. So we've got a question from Young Parker, Sammy Ty. Appreciate you putting that in there. So it says, are there any chances that rates will go back to the 8s? I understand the Feds are planning to reduce their rates since they claim inflation is under control. So first of all, there is always a chance that things could happen. And what would drive mortgage rates to the 8 is if we saw this inflation report, next month's inflation report, moving in the wrong direction. If we saw inflation increasing instead of decreasing, that would panic the Fed. The Fed would probably raise rates very quickly because of what happened back in the 70s in a very similar situation. So if that were to happen, and that is a very, very small percentage, very unlikely to happen, but that's what would cause that to happen. And it's of course possible, but it's also possible that my wife would tell me, no, don't worry, you can go ahead and go on a date with Margot Robbie. It's okay. So, you know, possible, but probable, not really. As far as where rates will go and what's affecting them, I'll take a minute and we'll dig a little bit deeper. So mortgage rates, I'm going to show you guys a fancy chart. Let me see. I just got to tell the computer. I'm on my portable, so it's a little bit different here. So let's see. Okay, hold on a second here. Present, stop screen share, present, share screen. Okay, so I'm going to just share the whole screen and then I'm going to bounce out of the way. So let's see if I put this up there. All right, so you guys should be seeing that. I'm going to take that comment off for a minute. Let me take the rate for, okay. So now you guys see the window to my soul as it gets smaller and smaller. Let me bounce over here and show you guys a little bit of deeper stuff here. So this, what I'm showing you on the screen now, this is a fancy chart of what we call mortgage-backed securities. Mortgage bonds trade based on, basically the markets as well as other bonds. And the one that we're going to most likely see it classified with is the 10-year treasury. So if I'm an investor and I could be an insurance company, I could be a retirement fund, I want to park money in a safe spot, but I want to get a good rate of return on that money. Well, the safest spot to put money is to buy US treasuries. They're guaranteed by the federal government, so they won't default. But because they have the highest level of guarantee, they have the lowest rate of return generally, right? So the more safe your money is, the less money you make on it. If I've got money and I want to be aggressive and I want to risk that money, but I want to get a higher return, generally I'm going to buy stocks. I'm going to invest in things outside of that market. Well, what if I want something a little less guaranteed, a little less secure than treasuries that'll give me a higher return, but I'm not comfortable enough to really put this money at risk. I need this capital. I need this money. I need this for safety. Well, mortgage bonds are a great thing to buy. And the reason mortgage bonds are good is because they're guaranteed basically by a property, and you also have a lot of them that are in one security. So what happens is there's not just one mortgage that you're invested in as an investor. You're basically stacking mortgages into a big cake, and then they slices out of that cake, and you're getting a slice of multiple mortgages. So it spreads the risk around. And generally the risk to mortgage bonds, it could be default, that somebody doesn't pay their mortgage, and that could lead to a default situation, which would hurt that equity in your bond. But it's actually early payoffs and refinances that cause more of a concern. Now, sometimes what happens is if I'm getting a rate of return, right now on my screen, I have a 5.5 coupon. And again, some of this is oversimplified, but in order for us to just kind of understand it, we're going to go with that. Let's pretend that 5.5 coupon means I'm getting an interest rate of 5.5%. That means that if I buy a mortgage bond, let's say I'm buying one bond, like this little speaker here, right? And this is $100 bond. That's what this value is at the maturity. When the bond is mature, I'm going to get $100 back on this bond. And in the meantime, I'm going to get 5.5% interest when I buy this, because I'm putting my money to work, right? So that 5.5%, that's pretty good in this market right now, right? If you put your money in a savings account, you might get 4% or less. So 5.5% is good. Well, because of that, I may have to pay what's called a premium for this. I'm not going to get this for $100. I'm going to have to pay a little bit more or a little bit less for this. So right now, if to get a 5.5 coupon, even though that's pretty good, there's better opportunities out there. So I get this for a discount. So I'm going to pay $99.91 right now to get this $100 bond. And when it matures, I'm going to get $100. So I'm actually getting a discount to buy this, and it's going to get me a 5.5% return. Now, if I go to a 6 coupon, that one is giving a 6%. So it's going to give me more interest over time, but that's going to cost me more. So now instead of $100, it's going to cost me $101.13 for this. And that number changes on supply and demand. How many bonds are there available? How many people are buying different bonds? And just like stocks trade, so do bonds. And that's what we're monitoring during the day. And that's what this fancy chart is. And the better the bonds are trading and the more they're worth, the better your mortgage rates get. That's, again, oversimplified, but that's how it works. So if we continue to see these bonds sell for more, this bond, this 5.5 bond, I could have gotten in October when rates were at their worst. I would have gotten this for $94.20. I would have saved about $5.80 on this. But today, I'm only going to save about 8 cents, 9 cents, because there's more demand for it, because the investors recognize that interest rates are going to start to fall again. and everything kind of exists and works in a, in an ecosystem. So as the Fed is expected to go ahead and cut rates, and we monitor that with this fancy chart, the Fed is currently right now about a 70% favorite to cut rates in March. Now, if you listen to different Fed members and you watch, read some Bloomberg articles, watch a CNBC once in a while, the Fed officials are saying, hey, we're not trying to act too quickly. They're trying to temper expectations. However, traders and the markets believe, you know what? They can say what they want, but the Fed is going to have to act soon, because we're going to see that if they don't, rates are too high. So the Fed raised rates over the last 2 years to rein in the economy, to slow things down, to slow down spending, to soften the labor market. Well, it takes a while to see the effect of what they've done, and they call that lag. So everybody's expecting that the Fed needs to act and cut rates sooner, because they raised rates to probably a little too much, and we're going to see the economy start to slow down. But by the time we see it, we're going to have wished we had already started cutting rates. And that's kind of where they're at. So even though the economy is still doing well, the labor market is still doing well, there's some signs of some cracks in the foundation. And that's kind of where we're at this point, where the and make that change. Why is it not do? There it is. And that's kind of why it's unlikely we see rates go back up. Markets believe the Fed has really gotten a handle on inflation, that it will continue, kind of like that we had to get the locomotive moving. If you've got to train a locomotive, it's extremely heavy, takes a lot of energy to get it moving. But once it's moving, now it's going to take a lot of energy to stop. And that's kind of what they're betting on, is that this locomotive is now moving. Now the Fed needs to go ahead and dial it back so we can slow it down. So, Mike, does that make sense? And what would you do to maybe add to that, or agree with it, or anything you like?
No, I thought that was a great explanation. That's the best I've ever heard it explained before. I'm, a little bit newer to the industry. I've been in it 2 years, and that made more sense to me than what anyone has told me before.
Yeah, we have a lot of people in our industry that talk in the jargon, and that's fine. But it is for, it can be very confusing with what's driving all this stuff. So if you're thinking of buying a home, it is a great time, and now is a great time. A lot of people, Mike, they're saying, well, I want to wait for rates to go down. And how would you answer that consumer, that veteran, if somebody, that family, if they came to you and said, Mike, we want to buy a house, but we want to wait for rates to go lower? Why would they want to maybe consider trying to buy now versus then?
Well, when rates get lower, you're going to have more and more people decide that they want to buy, and you're going to have more competition. With more competition, that raises the prices of houses. So when rates are higher, there's less competition. You're able to get seller concessions, get your closing costs paid for. But I remember a couple years ago, that's when I sold my house. There were people lining up out the door, multiple offers, and it was harder to get your offer accepted, and you usually had to pay over asking price.
I talk about this a lot. We get a lot of people that join, kind of watch it for the first time. What normally happens is that when rates go down, prices go up, because there's more demand. More people can afford to buy, more people want to buy. And that means that there's more demand than supply. Price will go up because of that. Generally, when rates go up, like we've seen, we should have seen home prices go down. However, we didn't see home prices go down this time. And the reason for that is the golden handcuffs. Golden handcuffs are the people that are in a home at interest rates in the 2, maybe the 3 or 4% range, that don't want to or can't afford to move. So the inventory was so tight. We had normally people are buying homes, selling homes. It's a process. But this time we had so many people that were just hunkered down, even when rates went up. And that should have increased the supply of homes on the market, which then, how do you sell your home? If your neighbor is selling and your neighbor is selling, well, generally, somebody's got a nicer kitchen, somebody's got a nicer backyard, but it's going to come down to price. So I might need to lower my price or be more aggressive in my price. And that didn't happen this time. So because of that, we've seen home prices hold very steady, which we've talked about for the last year and a half that was going to be. When people said, oh, we're in a housing bubble, I said, there's no housing bubble. You're not going to see home prices drop. Now we're in a position for rates to go down again. And remember what it was like a year or 2 years ago when rates were lower, still an inventory problem. Well, if you got 10 people that are trying to buy one house, the way they're going to do that is by offering more money, and it drives the prices up. So that's why that, to reiterate for you, now is a great time because you're going to get that advantage of less homes, more homes on the market that are for sale, less bidding wars, and less fighting to get those homes. And if you get a mortgage now, and let's say you get a loan, and just for a round number, let's say that you get a loan for 6.5%, and in 8 months or a year, rates are in the fives. What options does someone have, Mike?
Well, with the VA loan, you have the EARL, which is the interest rate reduction and refinance loan, and that's becoming more and more people are getting mail about that right now and talking about it because rates have been so high, just even the last 2 years, that you could take advantage of that pretty. If you're in the sevens or eights, you can get an EARL pretty soon right now and save yourself a lot of money.
So, and also again, when it comes to when is the right time to refinance, I strongly suggest that you shop around, find a mortgage professional that you're comfortable with, especially here in our vetted VA community. You can go to vettedva.com and find a licensed vetted VA mortgage professional in your state, and they'll be able to help you to decide when is the right time to refinance. Because believe it or not, there's requirements for how long it takes until you can refinance, but you also have requirements for how long, how much you have to save, and how long it's going to take to recover your expenses, because there are expenses to refinancing. So even though you may be able to go from, say, again, just to use round numbers, these are made up, maybe you go from 6.5 to 6, but we know that we're in a market where rates are likely to continue to fall for a while. Maybe you hold off for a little while until rates get down to 5.5. And again, this is something that you should discuss with your mortgage professional, the pros and the cons. And nobody has a crystal ball to tell you what's going to happen, but what's expected to happen based on the current economic conditions, the current inflation conditions, is that we are expecting to see rates slowly move lower through the year. And maybe you don't want to do that early in January. Maybe you want to wait until March. So again, you've got to decide what's right for you. I would advise doing that with a mortgage professional. Mike, what about you? What would you add to that?
Yeah, the same thing. It's better to start having the conversation now to see where you're at right now, and see if it makes sense. But if rates are in a declining environment, which we're talking about, if you've already got the ball rolling and started, when that rate hits a great percentage that you're comfortable with and ready to do it, you can get it done.
Absolutely. So, well, everybody, hopefully that helps you in your home buying or your home ownership journey, and you found some value today. Again, we do this every week. You can join me each and every weekday or each and every day week. Which actually, young Parker Sammy Ty has a question again here. How come the interest rates across the country are not the same for all the different loan types? Example, the interest rate in Texas for a VA loan is 6%, Florida at 6.6.
I just actually had a conversation with this. The owner of my company's in Utah, and he keeps pricing loans out for veterans based on his home zip code rather than the zip code that they're in. There's for certain lenders in my area, there's a 3/8 to almost a 0.5 point difference between Utah and Florida and VA loans. Where you're looking to purchase absolutely makes a difference in your interest rate.
It has to do with loan performance, and there's a lot of things that go into mortgage rates on the back end, right? Mm-hmm. So one of the things that makes the geography an issue is loan performance, cost to foreclose, and ease of foreclosing. There's a lot of variables that go into it on that end. So in a place like Florida, it could be that less loans perform. There might be more foreclosures that might be harder to foreclose. It might cost more money to recover and foreclose a home. Because of that, that's all worked into the securitization and the pricing. So it is complicated. Try being a loan originator. We've got a sheet we have spreadsheets, and a lot of it now, like back in my day, you guys can tell I've gotten old. Not only do I have to wear glasses now, but back in my day, we actually had to sit with a pencil and paper and sheets and printed sheets and sit and kind of figure out everything. Now they have pricing engines. Mike, you guys are spoiled today. The computer tells you kind of all the variables, but there can be 5, 6, 7, 10 different variables on one loan: credit score, location, whether the occupation of the property, whether it's owner occupied, and different things like that. So all of these variables can make a difference. But as far as across the country and geography, a lot of that has to do with the back end administrative costs, cost of recovery, and performance and loan performance. Texas, it's much, they have different laws, and it makes it cheaper to do lending there than it does in Florida. So. All right. Well, again, thank you, everybody. Appreciate you joining us. Mike, is there anything you'd like to leave everybody with before we wrap up today?
No, I just appreciate being here, and I come on to learn just as much as the viewers hopefully are learning. So thanks again for having me, and hopefully I hear from you soon.
Awesome. And you've got 4 names. I don't know which one to use: Young, Parker, Sammy, Ty. Thank you for your questions today. Appreciate it. And if you have any other questions, just post them. We'll be glad to answer them. Again, thanks, Mike, for joining us. I can't wait to have you on next time. Everybody else, I'll see you guys next week. Take care, everybody.